The Dow Jones briefly hit 22,000 for the first time in history. What does this mean for you and your portfolio? And what's going to happen next? Hello, my name is Paul Carroll. I'm the CEO and founder of Efficient Wealth Management, a boutique wealth management firm here in the Woodlands, Texas. The Dow has reached that record high 22,000, but it masks a lot of things. First, that boost was jump-started by good news coming out of Apple. And it kind of brings in the problem with single company boosts to the index. Apple is such a large part of the index that good news in one company has boosted the tide for everybody. But Apple also reflects some of the problems we're dealing with in this economy. It is somewhat a monopolist. It's an economy that's increasingly being beset by market concentration. And it is somewhat seemingly unsustainable. What is the next iPhone for Apple? It also brings us the problem of indexes. Indexes, be it the Dow Jones or certain index funds that are not modified in some way, are highly concentrated in specific stocks. So not only has the index itself become highly concentrated, but we have a lot of investors in the country, maybe as much as 30%, that are also in those very same pure indexes. One of the things we believe in strongly is passive funds. All indexes are passive funds, but not necessarily pure indexes. So we don't have that concentration, because when the market does turn, and sooner or later it will, those purely index-driven investors are going to feel a lot of pain. The dollar is losing ground as we speak. There's moderate economic data out there. Now, the dollar losing ground is basically the rest of the world voting with its money, saying we're a little bit losing confidence in the United States economy and the management of that economy. Now, this is good for exporters. It makes our products cheaper overseas. And it's also good for investors who had the foresight to invest a portion of their portfolio in foreign equities. Because now, even if those equities have not gone up, their holdings have gone up in value due to the fall in the dollar. In addition to all this, the Fed is committed to raising interest rates and ending quantitative easing. This also is a bit of a dark cloud in the horizon, and hopefully they'll manage that transition as well as they've managed quantitative easing in the last few years. But it is more money that will be taken off the table. We're looking at the end of an 8-year bull market run. In fact, I've got a table, a little chart that I've shown that shows the bull market through 2009, also shows the increase in margin that's being used to feed that bull market. We are in a market environment that has a certain Alice in Wonderland quality. What we would say is be careful. Don't let these new high numbers make you suffer regret that you're not deeper in the market. It's a classic mistake at the end of a bull market. I don't know when this bull market will turn, but I know it's expensive and it's looking increasingly dangerous. Back away from the fire. Don't get burned. Our clients, we've got them in well thought out, diversified portfolios. Some of them we've actually moved back a little bit. They have nothing to worry about. We wish you the best of investing success. And if you like this video and would like more like this, please be sure to like us on the tabs below. That will enable you to follow the feed in future. Thank you.